Hi, sir.
Yeah, 1 minute. Yeah, we can start, sir. Now we're live.
Yeah. Respected Chairman, Chinnamasan sir, in absentia, and the Secretary Gilly sir, in absentia. And today's speaker and the past chairman of SIRC, Jomon Judge sir, and the fellow professionals who are attending this program. Namaskaram to you all, and I welcome you all for this special program and company audit. Though we are late, but still the informations are very vital for this audit for this year. Company Audit 21-22, all you need to know. It's a good topic, and it has been beautifully coined by our speaker, by our institute along with the speaker. And the speaker is very familiar in this subject, is a past chairman of our SIRC. And I think we all can learn more things about the company audit from him, because he's very familiar and he has been delivering a lot of address on this subject. And though he doesn't require an introduction, but it is a formality that I introduce him also. Sorry, sir, I am introducing you. I think I'm not capable of, but still I'm
introducing. No problem. My pleasure.
Yes, thank you. Thank you, sir. Sri Jomon Josh is a fellow member of the Institute of Chartered Accountants of India with 30 years of diversified practice experience. He was a chairman of Southern India Regional Council of the CA Institute during 2019-20, and is a founder and managing partner of JVR and Associates, and specializing in corporate audits and consultancy. Is a mentor for Philip Macmillan Woods, a multidisciplinary accounting and consulting firm based in Dubai. Faculty for auditing at the Institute of Chartered Accountants of India, has taught more than 10,000 CA students. So through this, I learned that you are a good teacher, sir. Thank you, sir. I can learn more from you then. And faculty for auditing and institute for more than 10,000 students, a regular resource person on professional circuit on accounting and auditing standards and corporate audits, has more than 900 presentations. Also a peer review trainer, was a member of auditing and assurance standard boards of ICAI, was chairman of ICAI branch Ernakulam in 2002-2003, has traveled extensively in the UK, Middle East, and the Far East. He was a past president of Rotary Club Cochin Central and member of various social clubs. He is an honorary treasurer, Regional Sports Center Kochi, Farmers Secretary, Kerala Management Association, member advisory board, St. Teresa's College, Ernakulam, and he has authored a book, Trails, Pin Patakal. Sir, am I right? Sir?
Yeah, Pin Patakal.
Pin Patakal. Reflections of Min Bimbangal Adu. That's the meaning. Yeah.
No, the path trodden.
Yeah. Reflections of personal and professional life, released in February 2021. Here is our sir for you, sir, to take over the session, sir. Thank you, sir. Thank you so much. Sir, before that, I just wanted to know, because I'm in the accounting standard committee as chairman, and I would like to get your advice in accounting standard for agriculture, sir.
For agriculture, okay.
Yes, sir. You can tell me later also, sir. Thank you.
Yeah. Internationally, there's a standard. Here, we do not have full-fledged standard as yet. Internationally, yes, there's a standard on agriculture. Now, yes, that sector getting more of corporate involvement and new agri methodologies evolving. It's a need of the hour. We'll surely discuss on that.
Yes, sir. Yes, sir. I seek your support in this, sir.
Excited to work with you.
Yes, sir. Thank you, sir. Thank you so much, sir.
Right.
The forum is yours, sir. Thank you.
Yeah. Good evening to all of you. The in absentia, the respected chairman of SIRC, my very dear friend, Chinnamasan Talakayala from Hyderabad. Naresh Chandragilli, the honorary secretary of the region, who has been instrumental in having me on board here with you this evening. Naresh Gilli, and very, as we say in Chennai, the resourceful treasurer of SIRC, very, very respected Sundarajan sir. We have worked together in the council 2 terms, right, sir? One term we are together. The other members of the managing the regional council, if you are there, and 90 of the participants who are onboarding with us, still the numbers are counting. I think in the new system, members have some technical glitch in getting connected. So let's hope that more members will join in. The technical team, including Selva at SIRC, once again, a warm good evening to all of you. I'm extremely happy to be part of this CPE program organized by SIRC. A good number of worthy programs are being organized under the leadership of Chinnamasa Talakayala. My memories, as I was introduced, go back to 1920, when we had all these programs physically in SIRC and at the branches. So somebody in lighter vein said, Jomon sir, you were the last physical chairman of SIRC. Now things are slowly changing because DC Jain was 100% virtual. Jalapati was 60-70% virtual and 40% physical, even regional conference that way. We had a good participation online also, the Coimbatore conference. And now it's Chinnamasan again.
We can call it as a hybrid, sir.
Hybrid, I think it is high time that with sufficient care we got together physically in large numbers. The American president has said the pandemic has ended in America. Here we still have stray cases of the pandemic. 3 weeks back, my daughter turned positive. She had typhoid in Bangalore. She was brought back to Cochin, and in the hospital she turned positive. I don't know whether she got it from the hospital or came with that. So that's a very mild version, not the kind of killer versions we used to have, Omicron and things like that. So what I was trying to say is I'm a people person. So addressing SIRC members on the screen is very painful. But then being in Cochin, you can avoid the travel, all that. You can get a larger participation also. We are, interestingly, SIRC programs have members, not only from across the region, they could be from Vizag to Trivandrum. It can happen, we have from other regions also. In fact, I've been getting a lot of inquiries from members, doubts, queries from members from Mumbai, somebody from Punjab, or all those things. So this is a platform which is like a www, World Wide Web, anyone can access, and that way it is good. So with this introduction, thanking the organizers for this program, inviting me for this program. Let us move on to the technical aspects of the presentation. The time is 5 to 7. Around 6:10, we will have, with your permission, have a 5 minutes short break, and then we'll touch upon all the important aspects. As the caption goes, Company Audit 21-22, all you need to know. With that, let me try to share my screen and so that we can go through the PPT. So is the screen visible?
Visible, sir. You can put it in slideshow.
It's a full screen?
Yes, sir. Yes.
Yeah. So the Company Audit 21-22, or for any year, ever since we had the 2013 Act, there is a new regime of audit. Before that, 1956 Act. I'm sure that we are, Sundaran sir, should be happy. I think we're almost hitting 100 soon. So members are ticking in. It's really nice because we are busy with tax audits. Then people ask, why? How can I have a session on company audit now? So tax filings may happen, but many of the corporate audits, particularly small and medium companies, are still in the process. Some of the audits, if you touch your heart and tell me, even in my office here, there's some of the smaller audits where there's no tax audit are yet to be started. Because we have the flexibility till October 31st this year. The UDIN can be generated within after 16 days of signing. So if you put 2nd September 2022 as the date of the board meeting and to convene the AGM by 30th September, which is the cutoff date, we still have time till 31st October to generate the UDIN. So that gives us some comfort, and the clients have not been responding, and many of them have reduced staff during the COVID time. They have their practical difficulties. We have very, very important new onerous responsibilities this year, 21-22. Therefore, it's a year of change, a year of transformation. One has to be extremely careful. extremely patient in learning and understanding what's a revised Schedule 3, whether it is a CARO 2020 reporting requirements, all those things. One has to be patient in learning and also careful in applying them, because we are applying for the first time. It may take some time, maybe a year or so, for the whole thing to evolve and settle. So, but here in India, we have a very specific framework for the statutory audit of companies. We'll touch upon some of the basics. Subject experts and seniors would have to bear with me. In every presentation that I do now, we touch upon the basics initially, because we have large number of members who are getting into the practice new, because some of them would have come back from abroad, some of them would have taken a voluntary retirement, some of them are switching over from industry to practice. And therefore, this basic understanding is essentially very, very important according to me. And the statutory framework we have, the key aspects of a company audit, if you see the statutory framework, Chapter 10 of the Companies Act 2013, which deals with the whole audit, and the chapter is captioned as Audit and Auditors. So that we will see in the next slide. We'll see which are the specific provisions and touch upon some of the important provisions in detail. So whoever is new to company audit, whoever is serious about company audit, should have a clear understanding of the statutory framework, which is given in Chapter 10 of the Companies Act. The second aspect is professional pronouncements. Accounting standards for the preparers of financial statements, and auditing standards, or standards in auditing as we call them today, for the auditors in how to discharge the audit, how to plan an audit, document an audit, collect evidence, form an opinion, and finally report on the financial statements. All that we have standards in auditing. The third one is specific reporting requirements. CARO, Companies Auditors Report Order, for certain companies. As you know, small companies are exempted. We will touch upon all that in the next 1.5 hours or so. We will touch upon all that. And CARO is there. IFC reporting. We call it ICAI now, internal controls over financial reporting for certain companies. And then the whole government of 143, 3EFG, all those points we will see towards the end of this presentation. We'll have some thrust on the new things, which is the revised Schedule 3 and the CARO 2020. So these are the key aspects around which the audit of a company or company audit process will evolve. Now, if you look at the screenshot, now how do we read the Companies Act today? Referring to a book may not be very advisable, because law is still evolving. The Company Law Committee's term has been extended. Ramaswamy sir and Chopra sir are both past presidents. The term has been extended. So they're still working on making the Companies Act more friendly, more, I would say that rational and less cumbersome. I would say that less draconian in the sense, because there's a lot of thrust on ease of doing business and reducing cost of compliance. For smaller companies, a lot of associated costs when they have to do the audit. But larger companies, of course, the ease of doing business is very important. And today, China is seen with a lot of disfavor. If you read the newspapers this morning, Apple is planning to shift at least 30-40% of their operations out of China. And there's a mood evolving, which is called the ABC, anything but China, the Davos meet and all that. Therefore, India would become a favored investment destination if you really gear up. So Companies Act is being tinkered upon, being improved upon. Therefore, reading a book will not be advised. This is the ebook which I'm referring to. If you go to the website of MCA, mca.gov.in, on the left-hand side top, you have the Companies Act 2013, the ebook. You just click, you can have all the sections, rules, but the most updated version of the Companies Act is found there. It is administered by ICAI, Company Secretaries Institute, and it is the most latest version of that. Of course, we can have books with commentaries and the procedures and things like that. So Chapter 10, this is how the screenshot would look like. We have sections 139 to 148, appointment, removal, eligibility, remuneration, and 143 is a very, very important section. Most important section as far as practicing chartered accountants or corporate auditors are concerned is powers and duties of auditors and auditing standards. Auditing standards is mentioned in the caption of the name of the section itself. And in 143 subsection 9, it says that every auditor, not every company, not every director of a company, every auditor, you and me, practicing chartered accountant, should comply with auditing standards in very simple terms. But it's quite demanding. And today it means that the auditing standards ever since APC was formed in 1982, 18 plus 20 to 40 years down, the establishment of APC, they have now today statutory teeth. Actually, it happened from 2013 onwards. So you take 18 plus 13, 31 years it took for the auditing standards to gain statutory teeth. Accounting standards had gained in the 56th Act itself, that continues through section 133, which is in chapter 9. The preceding chapter to chapter 10 is naturally 9, which deals with accounts of companies. That is where we have 128 books of account, 129 financial statements, and it is through 129 that we travel to schedule 3, about which we are going to have a very detailed discussion with a lot of interaction, I expect, on schedule 3, which has been thoroughly revised from the financial 21-22 onwards. So don't forget, 143 is a very, very important section, powers and duties of auditors. It is from 143 that Caro emanates from 143.11, if I remember correctly. So auditor not to render certain services, and goes on, the story goes. So this is chapter 10. This understanding is very important. So before we go into the other aspects of what's really new, I would like to do a recap. I did mention that there could be very senior members, but still some of the good auditing processes which were there, in my observation, this is the 30th year of my practice. And I was fortunate to serve the institute in various capacities, a regional chairman very recently. And when I was much younger, in 2005-06, Manoharan sir, when he became the vice president, he co-opted me to the Auditing and Assurance Standards Board. I attended all the meetings, 11 in Delhi and 1 in Mumbai. And the kind of work which goes into formulation of the standards is a phenomenon. It's phenomenal. There are a lot of references. The secretariat will do a wonderful job. The entire team of the board selected, handpicked people from industry, from academia, from the practicing chartered accountants, very learned council members. At that time, we had, the past president was who died at an early age from Kolkata. He was also there, and it was a good interaction. 2 days of, hardcore, thorough discussions and points evolving. But then today they have gained statutory teeth, so membership should really wake up and gear up to the pronouncements, comply with the pronouncements of each. So with that, let me go through this, what I mentioned about the audit process. Look at some of these things. Suddenly you may fly back to your articleship days. Opening balance checking. Today, there's technology for smaller companies. It is there's no concern about data security. The moment the audit is to be started, the accountant will send the tally data, the compressed version of the tally data to the article who did the audit last year. Not even to the official mail of the firm. The partner comes now, know that only when the student says that that data has come. But then with all that, earlier in our days, we used to tick from the previous year's schedules to current year financial statements, which are either a computer printout or even manual. I did my articles in Chennai, incidentally, that was from 88 to 91. So that system has changed. Today we have VLOOKUP and they do the matchmaking, and finally opening balance checking, a very important exercise which we should do. There is a separate standard. Those who are familiar with the standards on auditing, SA 510. 500 series is all on evidence. 510 tells us how to the importance of opening balance checking, particularly in the first time assignments, initial engagements, opening balances. So we have to make sure that they are properly brought forward and those balances are maintainable. It's not that a junior assistant making sure that arithmetically they have been brought forward perfectly. But take, for example, if there is an item called land for 3 crores and there are 3 properties in and around Chennai or Hyderabad or Vizag, wherever. And then the auditor should, for the first time when you're doing the audit, you should essentially insist on seeing the originals of the documents, title deeds, sale deeds. And if it is with the banker for a loan taken, you should get a confirmation that the originals are held by them. To that extent, we have to go. Why I'm saying this is reiterating this because audit over a period of time, because of technology and because of the time pressures which are artificially pushed on us, we have a great big challenge of saying that, okay, audit has been reduced to a compilation. Mostly a compilation, preparation of financial statements. So you get a trial balance, prepare financial statements somehow. Alongside, for tax purpose, you do a statement of computation of total income. And some kind of compliance, implied compliance, it happens. There is no conscious, for many, maybe there are perfect models on board with us virtually now. But then many of the 90% of the cases, there is no reference to accounting standards. Application and the disclosures are not sufficient. Standards on audit is dismally poor. The FRRB findings, if you see, Financial Reporting Review Board findings, if you see, it's really disturbing. It's really disturbing. I wish made people like the former MCA secretary to make a statement saying that we do not want the auditors to see the needle in the haystack, but they should see the elephant in the room. So major audited, major financial accounting irregularities or lapses are going unnoticed because it's compiling financial statements and signing in a hurry, and therefore, major audit considerations sometimes take a backseat. Internal control evaluation and communicating to those charged with governance, a very important thing. If you read SA 315 and 260 together, then not only that we have to understand the entity, its environment, the controls, the processes, the people, the quality of people, etc. And then based on that, you should communicate to the management. 260 is a healthy practice. We call it audit observations in our office. Vouching, maybe some of the seniors may say, okay, you're going into the very basics. Yes, very much. Vouching is an important exercise. Source documents have to be verified, either hard copy or e-vouchers, and they have to be ticked with reference, checked with reference to the entries in the books of account. Ledger analysis, individual ledgers have to be run through, scrutinized to make sure that there are no irregularities. Every ledger account looks the way it should look like. And today, if you see the reporting under Schedule 3, to cross-check all that, transactions with struck-off companies, cryptocurrency transactions, the company acting as an intermediary for anti-money, money laundering transactions, the auditor should really run through the accounts. And one-off transactions, irregular transactions should be highlighted, discussed, and sorted out. In the case of listed companies, we also have the applicability of SS 701, key audit matters, that we will see towards the end of it when we come to the reporting standards. We are still at the very entry point of the presentation. Ledger analysis, verification of assets, liabilities, documents of title, like I said, sale deed of land, then RC book of vehicles, all those things, software licenses, legal versions which have been acquired, the documents of title for intangible assets, patents, copyrights acquired by the company, retained by the company, all that's very, very important. So verification is another important exercise. If we are not doing it, we should do it. Analytical procedures, yes. Trend analysis, ratio analysis, inter-firm comparison and intra-firm comparison, both has to happen. Both have to happen, and therefore that's very, very important. Comparing financial statements with underlying books of accounts. Today, we don't have bulk thick printouts, but the soft copy which is there. A final trial balance, please get it signed. Please get it signed by, I may sound old-fashioned, but they can sign it digitally and then mail it across to us, or a hard copy is also fine. This one should be done, and financial statements, because the trial balance is a conduit, the connecting link between the books of accounts and the financial statements, right? It is through the trial balance. We don't go directly. It is through an extract, which is the trial balance, and then the financial statements. EIS and Ind AS compliance, very, very important. Accounting standards, we have 29-2 accounting standards, a large number of Ind ASs. Ind AS is applicable only for listed companies and companies with net worth exceeding 250 crores. We'll see that we have a few slides on accounting standards. All these points, most of them are expounded in the slides to follow. And I will share the presentation, the deck with the SIRC, so that if need be, it can be uploaded. Normally, I think there's a practice of uploading this on the website of the institute, and therefore, SIRC, and then members could probably draw from that. Moving on, we have Schedule 3 compliance, all the information for notes on accounts. And we'll go to Schedule 3 and some of it have completed, but still there are loose ends, doubts, and some of the audits are to be completed. So Schedule 3 is a completely new version. But let me tell you, my friends, so I should not be addressing his friends. The senior colleagues may be there. So respected colleagues, two of the C&AG audits we have been appointed in Kerala. We have, there is, one has a CA and one is headed by a CFO as a Coast Guard. Both these people were not aware of the change that had happened in. So one audit, they say, sir, we'll do it, we normally do it in October, November only, belated returns. We sent 2 reminders because C&AG appointment, we should be active. So we sent 2 reminders. It's a company with a turnover of 200 crores. They're going in a very slow fashion. So I said, okay, we have sent a checklist for audit readiness and we said we'll start only after getting this complete. Where there's a chartered account also, unfortunately, they prepare financial statements. Very good. Some of them do not. And then there again, the first set of financial statements brought to us were not, it is in the old format. So we had to educate them. I shared this presentation, send a format which is there for new Schedule 6 and Schedule 3 and all those things, and also inform them that there are CARO reporting requirements. We had sent a letter earlier to our non-C&AG clients. C&AG clients, of course, there was a communication which was not exhaustive, full. To all our other clients, corporate clients, we had listed this new requirements and asked them to be audit ready. There are full-fledged accountants and there's an accounting team. So I'm cutting the story short here, and Schedule 3 compliance is very important. And most important for the auditor, CARO points, we have to do informed reporting. All the required information has to be collected. And at this point of time, let me tell you, we will surely come back to that, highlighting the importance of SF580 written representations, management representation letter, MRL as we call them. So I had maybe about 2 months, 2.5 months back, I had sent a mass mail to the members of the Southern region on the revised Schedule 3 as well as CARO 2020. Editable Excel version for Schedule 3 and editable MS Word version for CARO. If you have not received it, feel free to get in touch. I can surely share. The whole idea was that when these changes came in my office, since we are all actively in academics, there would be branches would be asking us to present. Members have to be updated on this particular aspect. So finally, we said, okay, we will do this. We did some homework. And with that, we mailed across to the members because everyone, again, do not have to reinvent the wheel. With that in mind, I had sent. So hope it has reached you. And maybe about 2 weeks after that, I had also sent a fairly exhaustive MRL, management representation letter, which we are supposed to get from the management. So 1 minute. Sorry for the short interruption. So this is what it is. With this, we will move on to the 21-22 specifics. And the big question, what's new? Schedule 3 revised format. I did mention about Section 129 and CARO 2020. Both are applicable from the financial 21-22. Let's look at Schedule 3, the major changes. As you know, the rounding off has been made mandatory to hundreds, thousands, lakhs, millions, crores. And so people ask me, how is this rounding off or decimals thereof? I hold this view. There's a figure of, let's say, 1,97,326, 197,326. If you're rounding off to hundreds, it will become 1973. If it is to thousands, it will become 197. And some of the listed companies we have seen, they have used decimals also. My viewpoint is that it need not be, because this rounding off is fair and this is what is expected according to me. The second question is, how will the taxmen, will they agree? So computation of total income and filling up of the figures in Form 3CD and all that, that should be the full figures. But then for the Companies Act, this is mandatory, it's not optional. So one has to keep in mind. The second change is that on the face of the balance sheet, the term tangible assets have been replaced with the term property, plant and equipment. That's a new accounting standard 10 also. Accounting, we don't call them fixed assets, tangible assets, etc. Property, plant and equipment. There's a new requirement to disclose promoters' shareholding, opening, closing, and percentage of change. We normally show it under the 5% holding details, which we are used to providing. And again, at that point of time, let us pause for a minute and say that whose responsibility is to prepare financial statements? Theoretically, it is that of the management. But here, we as auditors of small and medium companies, 99% of maybe 100% of those companies do not have the internal muscle or the knowledge resources to prepare financial statements. They may give you a tally generated or a QB generated FS financial statements, which is way off from the Schedule 3 requirements. So we help them, but technically speaking, it's not actually it's prohibited to help them in doing that. But then that's the way things are everywhere. So we help them doing the preparation of financial statements, small companies. That's why it's important for the auditors. Ideally, this should be a session for corporate accountants or, not the CFO level corporate accountants. That they are the people who should really prepare, show it to the CFOs, and then finally, only after that, technically speaking, it should come to the audit. We not only prepare financial statements, we also write the director's report, in which we also reply the comments on adverse remarks by the auditors. That's how things have turned out to be. But then technically speaking, let's say that preparation of financial statements is no part of the audit. Unfortunately, our new generation, the students are also catching up with that kind of a thinking, that audit is all about compilation of financial statements. That should be corrected. Audit considerations remain quite very important and paramount, not just confined to preparation of financial statements. So promoter shareholding was a promoter is defined under the Act. Promoter holding people who are promoted the company, who have decisive influence on the day-to-day running of the company, etc. Independent directors, thankfully, are exempted if they have shareholding. They're not a part of the definition of promoter. They cannot have shareholding, so they're out of the definition of promoters. Aging and date of completion of capital work in progress and intangible assets under development. See here, capital work in progress in the normal course of this thing, if there is a project with a gestation period, a pipeline, a building, or some kind of a development work, a integrated machinery complex or integrated plant, like our Kochi refinery, BPCL Kochi refinery last 2 years back underwent an expansion of 20,000 crores. Chennai, I'm sure that Tamil Nadu and Andhra, Telangana and all that, Kannada, everywhere you have bigger projects. So in that case, what happens is the capital work in progress, it may take 2-3 years. So the idea of asking us to give asking the management to give these details is to ensure that the financial statements give all those details, so that if there is a problem, if projects are held up, suspended for some reason. In Kerala, Tamil Nadu today, we have all these ecological co-considerations, ecologically fragile zone, environmental concerns, and therefore some hill station project of a resort may be suspended. So it remains the balance sheet is capital working across n number of years, having hit a dead end. That's not going to happen. It has to be written off. It is a loss. It cannot be the amount which you spend there. You cannot even go there. The government would have taken possession of that particular land. Then it cannot be carried as capital working. That's the whole idea. So aging as well as expected date of completion. Now here, what happens is, if you look at the spirit of Schedule 3 and CARO 2020, I feel that it has been drafted from a banker's perspective or financial lender's perspective, bringing in a lot of discipline and additional disclosures. Not to an extent it is transparent, excuse me for using that term, to a statement where it is naked. Everything is to be disclosed. So that will bring in more of discipline in corporate reporting, but at the same time puts a little bit of burden on smaller companies and things like that. So transparency is a key. And aging, when we talk about aging in the new Schedule 3, if you see, the spirit of that is whatever is old in figures, I repeat, all those old figures are bad. They're not good. You smell the rat. Same is the case with intangibles under development. We have startups everywhere. Experts like Chris Gobarish and all of them have said that only maybe 10%, even less than 10% only would blossom into successful projects. Some of them become unicorns and all those things. From Kerala also, I'm not being state specific. Kerala also, we have a unicorn in which a chartered accountant is involved. Dina Jaka from Kottayam is one of the promoter directors, a company called Open Financial Services. to become a startup unicorn. That is 100 crores of valuation, 1 billion valuation. So that's really good. And so this is a new disclosure requirement. For the startups, all those for all of them, the first year, a few engineers or techies may be sitting together and then take a place on rent, etc., etc. And then the expenses are accumulating. We cannot be capitalized at that point of time. Because let's say in the first accounting period, reporting period, it's only 9 months. 9 months, it is still in the conceptual stage, development stage, they have not reached. For example, an app for financial inclusion, app for telemedicine, or app for elderly care. An app is being developed. So this app may be, the work may be underway. So how long can it take? 9 months? Another 12 months in the next financial year, let's say 22-23, or it started in 2021, flowing into 21, or flowing into 21-22. And finally, with all this, at some point of time, they should say that here is a product, or here is a concept, or here is an app which can be commercialized, which can generate revenues. At that point of time, all these accumulated amounts we will capitalize as intangible. I hope I'm clear. I'm hoping that I'm not going very, very fast. Members can respond if admin can occasionally unmute the participants occasionally, and if they have some questions. And sirs, you can use the chat box, also Q&A. If there's some questions to be asked or some suggestions to be made, the chat box is open. This is a friendly Zoom platform, and Q&A is also there. Feel free to shoot questions. So it means that it gives me an impression, feeling that we are still with me, we are together, though we sit in different parts of the region or the nation, country altogether. Current maturities of long-term borrowings are now, we will require to show them under short-term borrowings. Yes, Jayan Dasher sir has asked this question. Yeah, PP in place of tangible assets on the face of the balance sheet. Is impairment is mandatory in capital work in progress? So AS 28, if you apply, tests of impairment have to be applied, because capital work in progress, ideally impairment is for an asset which has been put to use, and it is the evaluation of its earning capacity. CWIP stage, we do not look at impairment. That is, I feel it should not be impairment. It should be whether the project can be completed on time. Otherwise, if there are doubts, some portion of the value may have to be written down. It cannot be called impairment per se. Impairment for an asset which has been commissioned and used. That's what I feel, but we'll continue to discuss. Yeah. So current maturities of long-term borrowings are shown under short-term borrowings. I'm 100% against this. This should have been under current liabilities as we are showing it. And now the borrowing, it's not a short-term borrowing. The borrowing is essentially long-term. The part of that, the installments which would fall due in the next 12 months, and plus those would have fallen already due by 31st March, and there are some overdues. That's current maturities. That can only be a current liability. This is, I do not agree with it at all. Aging of trade payables, see, Tom Joseph has asked this question, sir. Round off of 198236 in hundreds to be done as 1982.36. This is what we do for C&Js. 0.36 can be done away with. That's what I say that, because if you look at that, this notification says or in decimals thereof. Decimals are all not required. Good. Alpa Shah has asked this question. Is revised schedule the presentation PR balance sheet for services company where stock purchase, etc. not available? That is line items. Not available or not applicable. It should not be not available. All type of companies, and no companies are exempted. No companies are exempted from the applicability of Schedule 3. In CARO, we have a few exemptions for small companies. But the Schedule 3, to the extent relevant, they are applicable in total. How to show wrote-up script purchased from other company and where to show unutilized value as on 31/3/2022. Yeah, wrote-up scripts purchased are for enabling imports. So that can be under other expenses, the purchase, net of inventory, net of stock, and the stock can be shown under current assets. Other items, because this is your inventory which should soon be used within 1 year, or it cannot be inventory. It can be, you can show it as separate line item under after inventories as stock of earlier it was MEIS scripts, and now we call it wrote-up scripts. I hope I answered the question. The principle of recoverable amount still holds good for capitalization under capital work in progress. The standard on borrowing cost will be applicable for capital work in progress, and hence apply borrowing cost once we add it to A16 impairment and recoverable is taken care of. That is a suggestion. That's an answer from Balasubramanian sir. Thank you for that. And A16 is a standard which has to be carefully applied. So capital work in progress, naturally, yes, capital work in progress will surely have an element of borrowing cost if it's a qualifying asset and the principles of A16 are justified. Should earnings per share in the P&L account be rounded? Should not be. Should not be. Earnings per share, you cannot round it off. Will ordinary expenses like fuel purchases, coffee, photocopying, etc. fall into trade payables or last month expenses, or does it require inclusion in disclosure? They'll all be creditors for expenses, sir. They'll be creditors for expenses. Sundry creditor trade payables, where we show it as for purchases, for services, for expenses. They'll all be trade payables. You are right. I have answered the questions, all the questions. I think one more. Yeah, Q&A that I've answered. Unwanted heads and subheads can be deleted. Yes. It's okay in doing that. But if you look at the schedule 3, in the format, there is no flexibility. In the earlier schedule 6, they used to say, or in a format as near thereto. But that flexibility is not there. But I don't think there's any issue in having all the unwanted, for small companies, all the unwanted heads and subheads being deleted. I agree with you. We move on. Aging of trade payables is again new. And look at the slots we have to have: less than 1 year, 1 to 2 years, 2 to 3 years, more than 3 years, and the total. MSME dues and non-MSME dues we have to show separately if available with the company. This challenge is there everywhere in the financial schedule 3 also. So where we are asking the management to identify, if we are not getting the complete list, then we are putting a note. That still continues. That's the only way we can do it. That companies in the process of identifying, and there has not been any demands under the MSME Act and all that we give. So MSME, if available, has to be given separately. And this is a tabulation which we need to make, all in a columnar form. So the shape of the balance sheet is fully gone. If you say that the layman's terms, the readability of the balance sheet is reduced. I would also quote very revered Y.H. Melagam sir. He said that with all these technical standards, financial statements or reporting would have become more perfect, but much less readable. So now is the first time when we prepared all these schedules, the flow which we used to have in the portrait format has been lost. In many of these schedules have to go into the landscape format, and then we do it customized, and separate sheets may be required. Not maybe, it is required. Trade receivables also, disputed and undisputed, have to be shown separately. Less than 6 months, 6 months to 1 year, 1 to 2 years, 2 to 3 years, more than 3 years. And more than 3 years, naturally, if it is 2 to 3 years, more than 3 years, when you see that loudly, a doubt arises whether there's a need for making provision for bad and doubtful debts. There's a need for right of more than 3 years. Limitation, if they're not renewed, maybe the law of limitation would have applied. It may not be recovered. One has to keep the eyes and ears really open to that. Details of immobile properties not held in the name of the company. This, according to me, will happen in very, very rare situations. But there's a very common practice amounts, at least in small companies. In the Middle East, it's very common. If you go to Dubai and if a company is not doing well, if the banker says that the shareholders, the promoters' holdings have to be increased, the national there, the Emirati would say, you include my property in the balance sheet. Include my property in the one more property in the balance sheet. So International City, I have a small plot, and then the title deed is only like a certificate. It's not the stamp paper one which we have here. He says they'll very coolly pass an entry, land and building, that there's a building, to shareholders' current account. That's the term they use there. And that's being accepted even by larger firms who are auditors there, that's being accepted. He will just give a consent letter, or there may be a resolution saying that this is part of it. But in our context, a property will become the property of the company only after conveyancing is properly done. If I'm the director of a company, I'm saying that my property is transferred to the name of the company. It under the Transfer Property Act is triggered. I have to do the registration, conveyancing, pay stamp duty, and then apply for mutation. After mutation, the name in the register, village register, will be changed that to the name of the company. And then after that, the company has to pay tax in its name. To that extent, we have to do. If we are buying, if we are in counter point, which I ask is, if we are buying a property, should we don't do all this? We should, and we will, we must. So if there are any immobile properties in the balance sheet which is not held in the name of the company, according to me, the only situation which would come is the conversion which would have happened under the erstwhile 56 Act, where there was a provision to convert a partnership firm into a company. There, the provision said the assets and liabilities of the firm would vest into the new company. There's no transfer required there. So that was one way of reducing stamp duty, capital gains, all those things were not there. It was only vesting of the property, and it was not subject to stamp duty and capital gains. I'm open for a debate here. So that's the only situation I'm seeing there. Otherwise, this very loose practice of converting property into company property by passing an accounting entry, no, it's not maintainable, not sustainable. Whether revaluations, if any, during there have been done by a registered valuer as defined in 247. And if there is a huge change in revaluation, the net carrying value is affected either upward or downward by 10%, more than 10%, then the full details of that has to be given. All this we show under the schedule of, we call it, still we try to say FA schedule, fixed asset schedule. So scheduled property, plant and equipment, we show all this. Now all the immobile properties shown above are held in the name of the company. None of the assets have been revalued during the fair enough. Utilization of borrowings, mostly on doesn't make a differentiation. So which gives an impression that both for long-term loans as well as working capital loans. This we are still in Schedule 3. We are not auditors. We are still preparing the financial statements. Auditor is in his office. We are sitting here as corporate accountants and doing the financial statements, right? So that has to be very clearly given. And if it is proper under short-term and long-term borrowings, we'll put a note below that note. We don't call it schedules in that note itself. The borrowings above borrowings have been utilized for the purposes for which they have been borrowed. But there could be cases of complete diversion of funds. Giving a project report for expansion, we raise some loans. And if you're a friendly banker, that would have been totally diverted. Maybe for children's education abroad, one director would have drawn, or some director would have constructed a house. So that reminds me of this story of an Indian minister going to a foreign country, and the minister there has got a very palatial mansion. A very palatial mansion and a lot of luxury cars and all that. So our minister is invited for dinner, and seeing this house is a little astonished, surprised. And they said, you are in public life, so how could you construct this kind of building or house and this kind of luxury, how can you afford? Then the minister there just puts a curtain there, and then little away from there, you could see a huge bridge and related structures there. You see that bridge there, and this is made out of that. You know how it goes. That bridge, I was in charge of that. It was from my department, maybe a PWD there, and then this was out of that. A few months later, our Indian minister also feels that this person should be, he should reciprocate the warmth and the hospitality extended to him, and invites him back to India. And this person comes, the same question. He has even more luxurious life. And finally, he says, well, then he opens a window and says, do you see a bridge there? No, there is no bridge. That is this house. So it's a different version of how we look at it. So borrowings have to be utilized for the purposes for which they have been taken. Chakravartin sir has asked this question. Sir, I'm coming to that point. Quarterly stock, debtors, and creditor statement is slightly vary with the books of account. Touch your heart, sir. Is it slightly or a major variance? let's be very clear. Coming to that point, yeah, you have both. So if you're asking in the chat box, fair enough. Q&A, you don't have to repeat in the Q&A. I have access to both chat and Q&A. So I request you mostly to chat in the chat box. Okay. Since instead of typing in to save time, I'm orally explaining, giving my views on that. Now, quarterly returns of current assets filed with banks are in agreement with the books of account. This is quite challenging. In fact, if it's a very truthful situation, there's absolutely no challenge. So how do we give the quarterly statements? When you have working capital facility, an OD, CC, a packing credit, a foreign bills discounting facility, post-shipment credit, etc., the banker would ask for this quarterly returns. So receivables, perfect. You take for example, 30th June. Okay, let's say we are nearing 30th September. 30th September, your books are up to date. You take from your trial balance a listing of the debtors, listing of your debtors, and find these are my debtors and these are my creditors. So debtors and creditors that way is okay if it's a clear situation. Without any goof up, they are giving it directly to the bank. And then in the format which is given by the bank, sometimes it's a soft copy. But sir, again, Jokhan sir, people have been asking, sir, the company is not in the possession of that. Then the auditor has to become, because if this has to be reported and the auditor has to comment on this, then what is the comment the auditor is making in here? Even in a case where the company is preparing the financial statements completely without recourse to the auditor has to report whether the financial statements give all the information required by Schedule 3 in the manner so required. So there's no escape for the audit. Auditor is equally responsible here, of course, in a different capacity. So therefore, here there's no challenge if things are okay. But 99% of the cases, even without the promoters knowing, the accountant would play around and saying that because he wants his DP to be increased, his DP to be intact at least. When there is a loss, there is a loss of value in receivables are gone down or receivables have turned bad, but still they show it as good borrowing, good receivables. The receivables, let me come to inventory now. Where do we get the inventory? The inventory, if you have proper SAP system or a proper interface, tally inventory module is activated. Quarter you take a printout, that's it. That can do it. But how many of our clients have this? And I'm expecting that most of the 132 participants here are small and medium practitioners. You and I are no different. I sit in Cochin, you may be sitting in another city. It could be Chennai, it could be a smaller town like Tuticorin, wherever. Where our clients do not have, if you take the stock report, it will be negative. So in most of the cases, in our cases, we had to say that there are variances, not slight variances, major variances, and it has to be quantified and given. Otherwise, it's a non-compliant Schedule 3, and the auditor will also have a problem from the angle which I just mentioned a few minutes back. I hope I have answered the question. Whether the company has been declared a willful default. Sir, the guidance note is making a reference to RBI's master circular for bank audit. Willful default was borrowed, essentially diverted the funds for something else, and even with amassed private wealth, and in spite of all that, is a demand, that is, he will not repay. Like someone said, it is against my principle to pay interest. Against my principle to pay the interest, and it is against my interest to pay the principal. So where will the bank go? It naturally will become a willful default. And how do you find out? You ask the company, you may not get it. You may have to even check with the banker. Take the phone and make a call. You are not prohibited. That there's no willful. Again, if the CC accounts are well within the limits, interest is getting serviced, there's no NPA, there's no, we say that, term loans are getting serviced. In such situation, it doesn't really raise the eyebrows. We don't get suspicious about it. But then if the accounts are stuck, there are no forthcoming repayments on term loans, cash credit is always overdrawn, and some stray payments are coming. And like in the bank audit, we say credits are not even sufficient to service the interest which is debited on a monthly basis. Then you have a doubt whether there is an issue, and that is the time you go further deep, do deeper dives, check with the management, the banker, and say that you're a willful defaulter or not. Whether registration and satisfaction of charges have been filed on time. So today, the regime is different. Registration, we have 120 days time. After that, you cannot with the ROC, you have to go to the RD. Satisfaction, we have only 1 month's time. CHG1, Form CHG1 and CHG4 that we file, that has to be done. So, but here the reporting point is whether it has been, the charges have been filed on time. If it's not there, you have to say that it's not done. Reporting of ROC registration are in time enough or disclose the details with date, etc., etc. No. If it's in time, then you say that the registration and the satisfaction of charges have been filed on time. Exact wording I can probably read out from this thing. No date and all that. If there's a default, you say that it has not been done. A charge which is created on so and so date on the assets of the company for the term loan taken from SBI has not yet been registered or has been registered with a delay of so much. Is this only for current year or earlier years also? This particular point is only for current year. Yeah. Let's move on. Details of loans and advances to related parties. This is actually not required because under AS 18, it's also part of the Companies Act today. The complete details of related party transactions have to be given. So in addition to that, and this loans and advances separately, but if it's already covered under related party transactions under AS 18, that's fair enough. Whether any proceedings have been initiated against the company under the Benami Transactions Prohibition Act. We have to ask, we have to get in the letter of representation, etc. But still, the guidance note is asking us to scrutinize through the legal and professional charges. Probably have a word within larger companies if they have a legal counsel, a retainer, an advocate, an attorney, a lawyer, as this thing. You can even get a confirmation from him that there are no such things. The next point, I have made it into a very simple two-line bullet point, whether the company has acted as an intermediary in a money laundering transaction. Those who have read that, the paragraph is very lengthy, whether the company has received the funds from a third party who is initiating this transaction and acted as just an intermediary for an ultimate beneficiary. I give this example. For example, an Indian company, your client was sitting in Bangalore or Chennai, is getting this amount from, let's say, 5 crores from a company, let's say, UAE. And then with an instruction that 5% you retain and transfer the balance 4 crores 75 lakhs to a company in Sri Lanka or Maldives. It's a sham of a transaction. This company doesn't have any continuing or regular business connection with those two companies. So here, because of a direct link, they don't want to establish, they're transferring it here. So in our client's books, there'll be one-off receipt from a company which has no business with this company, will remain as a liability, and net of the 5%, there is an advance given to another company. Need not be a foreign entity. It could be between a company in Kerala company initiating, we're giving something to Chennai, asking you to remit it to Vijayawada or Anantapur, wherever. All those transactions where it suggests money laundering. That's a good question. Are this part of CARO or Schedule 3? Sir, look at the caption. We are still in Schedule 3. In lighter vein, I am saying that the auditor is sitting in his office. He is still preparing financial statements. All these are part of Schedule 3. We come to CARO a little later. Yeah. So this is the kind of transaction. So this suggests money laundering, some kind of colored transaction. So therefore, it has to be given in the financial statements. So where do we give this? All these general things. We are coming to some more points. In the format which I had shared with you, we have added a separate line called additional disclosures, additional regulatory disclosures. Under that, we are showing all these things. And we also have the whole lot of current the ratios to be disclosed. The next slide is that. Now, still we have some more to go. Details of transactions, if any, with struck-off companies. See, if you have a doubt that this company is a struck-off company, again, a one-off transaction. regular running transaction with our clients, vendors, as well as customers, it doesn't arouse any doubt. But then struck off companies, yes, if there are there, based on the SIN, or if you have the SIN or the company name, you can do a search on the MCA website and make sure that that company is not struck off company. And do we need to disclose if not applicable? That's where I said, see, it's the practice which is being suggested is that you just give this, there are no transactions struck off companies instead of a silence. Because you have to explicitly make it clear that there's not been any transaction with this thing. Or look at the third bullet point. The company is, or section 135 of the Companies Act 2013 on CSR is not applicable to the company. So silence can be, deceptive. So the suggestion which is coming up in our discussions we have is that all these have to be given. Now, a receivable from a struck off company is not required. Here is talk about transactions during the year, but from a different perspective, a receivable from a struck off company has to be written off. So that's not going to come back to you. And they would have given a waiver letter from you for striking it off for STK and all that, for STK 1 or 2 as a form. So that they would have given a waiver letter from. After that, how can you carry that? So here it is talking about transactions only. Closing balance, I don't think it is required. Are these new requirements be part of the? Yeah, it is part of the notes on accounts, sir. That's what I was trying to say, Jomon, sir. That's where we show it under additional regulatory requirements. It's all part of the notes on accounts. Absolutely is. The second bullet point is on layers of subsidiary companies. Under the Companies Act 2013, 287, subsection 87 puts a restriction. I can have only two vertical levels. I'm a company. I can have subsidiary B, subsidiary C, not D. Horizontally, you can have as many. Vertically, you can go that way. But if one is 100% subsidiary, you can go one more level down. A company has a 100% subsidiary called B. B can have C and C can have DOs. That's the simple meaning of the layers as mentioned in 287. If it's not 100% subsidiary, A, B, C. If B or C is 100% subsidiary, A, B, C, D. That's all. Full details of CSR expenses spent, unspent. See, here we need to spend time because maybe some of the members are from metros where the provisions of 135 are applicable to your clients. CSR was enacted as a very friendly section. No penal provisions, etc., etc. If amount is not spent, you mentioned in your board's report. That's how it started. But today the whole thing has changed. Not without reason. The expected CSR spend of India Incorporated, Indian Inc. is 1 trillion rupees, 1 lakh crores in 21-22, which is very good, which is hopefully getting channelized into the real social welfare, remote villages, child education, all those important things which are mentioned in Schedule 7 of the Companies Act. You give a complete list of, aged care, geriatric care, sports. I'm associated with this in my introduction to said. All kinds of sports, educational activities, rural development, sanitation projects in a tribal settlement, all those things. So this has to be spent. Now, the point here today is that for the last 2 years, we have seen that the amount unspent, it is not just enough to give in the board's report. It has to take an accounting hit. It has to be provided for by debit to P&L account showing as a payable. Sir, I did mention there's a question in the chat box, again from Tom, sir. Additional regulatory requirement, disclosure requirement, in case there are no transaction or particular amendment is not applicable, there is no requirement. However, a few companies have voluntarily disclosed. That's what I was saying, that the disclosures have to be made. Like, for example, what prevents us from saying that? So if we are silent, it can be deceptive. It doesn't sound nice. So if you say that there are no transactions struck off companies from the examination of books of accounts, it's no books of account, we cannot mention here. It is the wording which we have used. I have a balance sheet which is with me here now. I just use that. Additional regulatory information, we have started with financial ratios, which in the PowerPoint we are yet to see. There are no transactions struck off companies under Section 248/560 of the Companies Act 2013/1956. No charges of satisfaction is yet to be registered with the registrar of companies beyond the statutory period. The company has complied with the number of layers prescribed under 287 read with applicable rules. There is no scheme of arrangements that has been approved in terms of 230 to 237 of the Companies Act 2013. The company has not advanced, etc., etc. There are the company is not covered under Section 135 of the Companies Act 2013. There are no transactions not recorded in the books of accounts to be surrendered, disclosed as income during the year in a tax assessment. Company has not traded or invested in cryptocurrency or virtual currency during the financial year. So this is how we have given. I'm just reading out from a balance sheet which is being signed, being finalized. So CSR, the provisions have to be made, and there are penal provisions for non-compliance today. And in 135, we have a reporting requirement under CARO. We'll see it there. Because there's a differentiation between ongoing projects and other than ongoing projects. We'll see when we come to that particular point. Details of crypto transactions even. Cryptocurrency transactions, a lot of transactions happening. They've all taken a dip now, crypto exchanges. And this time during the IPL, the maximum number of advertisements had come from betting companies and crypto exchanges, if you remember correctly. Betting companies, Dream Level, they were featuring people like the Bumrah, Rishabh Pant, all of them, and then Dream Big, Dream Level. The kind of money they make is huge. Probably towards the end of the, I have some interesting arithmetic of Dream Level. Towards the end of the presentation, if time permits, we'll discuss. So any crypto transactions, we have to get details of it, and the profit made, transactions, balance outstanding, all details have to be given in there. Ratios, you see, complete list of ratios which we have to give. Current ratio, debt equity ratio, debt service coverage ratio. Yeah, when it comes to trade receivables turnover ratio, it is the other way they have put it. Total credit sales divided by average receivables outstanding. Same is the case with total trade payables, total credit purchases divided by average outstanding. Look at return on investment. If you look at the guidance note is not mandatory. So people also used to call and ask this question. There's a guidance note on the new format of non-corporate entities. It's only a guidance note, it's not mandatory. In fact, for smaller firms and bankers, it's a pain to follow that. It's my personal opinion. Corporatizing that kind of a presentation of a non-corporate entity is really painful and very difficult to make sense out of it for a banker or for a layman, the taxman. Surely there will be a lot of questions. We'll have to educate them, and in a faceless assessment, how difficult it is to convince these people. That is incidental. So return on investment alone, the last point, don't refer to the guidance note. It is so misleading. They have given all the formula, sigma, and all those stuff from an investor's angle. ROI is nothing but PAT divided by the total assets. Total assets. That's what the ROI is. Return on investment. We'll move on. P&L, we have the term revenue replaced with the total income. Total revenue is not the total income. A new line has been added for Section 8 companies, non-profit companies, grants, donations received included. And to give details of unrecorded transactions surrendered but disclosed in IT assessments. This is a very important point. I used to discuss this example. I think I would have done a lot of all the branches in Kerala. Maybe about 20-25 presentations I would have done on Schedule 3 and CARO 2020. We did Hyderabad, Vijayawada last week. Yesterday, day before yesterday for the Kottayam branch. A lot of discussions happening on this, a lot of questions. Members have doubts. As I mentioned, factually audits are in the process of getting finalized halfway through. Some of them are yet to be started. With respect to matters to be reported in CARO, for example, ratios, is a disclosure required in financials for companies even where CARO is not applicable? And this has to be seen separately, ma'am. Schedule 3 is applicable for everyone. CARO, we are going to see after a short break now. CARO, there is no reporting requirement on ratios. CARO, there's a reference to ratios in that companies arriving at companies' capability to meet its liabilities. We do not report on the ratios per se in CARO. We'll come to that. But please see CARO and Schedule 3 separately. Schedule 3 is applicable for all companies. Okay. Section 8 companies also, which means that it is here. Government companies, private companies, small companies, inoperative companies, all of them. Schedule 3 is a new format. That's a new language of financial reporting. Let us not refer to CARO when we discuss this. What's a crypto transaction? Oh my God. Frankly speaking, I've not been able to understand. A lot of people are in crypto investments, the mining and all that. Artificial value derived out of certain algorithms and things like that. So this is slightly technical, but it is not regulated. In the recent budget, they have. I'm sure they have gone. Okay, and the latest budget, Madam said we are going to tax profit from crypto transactions at 30%. They said it has all been legalized. In our Indian context, it's not yet legal. It is trading on a non-tangible, intangible, trading on intangible, which they say is based on certain algorithms developed, and people keep mining all that. These are technicalities, but you have, as an auditor, you don't have to get into those technical details. See whether there have been transactions on crypto exchanges. And out of the outflows, how much has been booked in, and in real money terms, it has been mentioned in the books of accounts, and get complete details from the management. Crypto exchanges, they'll surely have the statements, and I've not come across, none of our clients, thankfully, have any transaction with crypto. And so that is how it is. A more detailed understanding, slightly technical. But the auditor doesn't have to be technically knowing all those details. Yes, sir, there's a question on CARO. I'll come to that when we reach CARO. So these are the things which are unrecorded transactions. We'll just complete this. See, there's an income tax rate in April 21, let's say. And assessment is completed by Jan 2022. So both are happening in 21-22. Everything is okay, except that there's a title deed, a purchase. The company has purchased land for 2 crores. That other way, all other things have been kind of eliminated, and finally the assessment is only on 2 crores. The accounting entry has to be passed. Now, here, what is the Schedule 3 says? In CARO, it's a different reporting. To give details of unrecorded transactions surrendered disclosed in IT assessments. So there's an IT assessment, and based on the order, if there are 2, 3, 4 items which have not been disclosed in the books of accounts, which have been surrendered, unearthed, surrendered, and disclosed in the IT assessment, all those details will have to be given here. Accounting is a separate issue. Accounting has to be done. That reporting requirement is on the auditor under CARO 2020. We will take that brings us to the end of Schedule 3. We can have more questions. So we will move to CARO 2020 after a 5 minutes break. Is it okay, Sundarayan sir, if you're there? Yeah, I had mentioned this in the beginning.
Yes.
So, Selva, are you there?
Yeah, I'm here, sir. Yeah, we'll have it, sir. Sir is also here, yeah.
Sundarayan sir, I'll take a short break.
Yes, sir.
5 minutes now. On my watch is 6:15. So what's the right time?
6:20, sir.
Sorry, 6:21. 6:21. And we'll meet at 6:25.
Yes, sir.
Yes, sir.
Yeah, Caro 20 will, there are a few questions. They're all session will resume at 6:25 p.m. Yeah, at 6:26, I'm 1 minute late. Not without reason. I went out of my cabin and the office had bought some snacks for the kids who are sitting late, students. In our office, there's no habitual late sitting, but whatever said the last 2 weeks of September and maybe last week of October, there's some late sitting, but never beyond 7. I think that's a good practice which all of us should follow. Always working late into the night doesn't make sense. Many of the members have health problems, yielding to the client pressure. We should not do that. And student culture also should be promoted, academic culture, letting them go on a regular schedule and all that. So what I was trying to say is that so I could have the parampuri, which is banana fry in Kerala we have, and a vada and a hot coffee. So that break turned to be good for me. Hope you could also take a break. Very good session, sir. Can we get the video of the session for our reference? I'm not too sure, SIRC, whether they will share the video. Selva, we are uploading the video or is this a PPT only?
Recordings will be uploaded later in SIRC YouTube channels.
Yeah, by what time?
Maybe
in a week's time.
In a week time, say in a week time. Yeah.
I'll speak to the chairman, and because this comment has come not because it's a thing. We'll ask request chairman to upload it slightly earlier because time factor is also important.
Yes, sir, please.
Please mail on the reply button. Please mail to SIRC.
Replied it, sir, actually, yeah.
Right. Okay, thank you.
Sir, it's all available in the YouTube, sir.
YouTube.
Yes, sir.
Okay. Now, Caro applicability, Palnisa's point I will answer as we get into the presentation. Okay. So Caro 2020, look at the date of original notification. It was February 2020. And all of us thought that it's going to, are you all back? Can we continue? Yeah. Okay. Yeah. So we thought it's going to come in 1920. It did not come. 2021, it was further deferred. Said that the corporates as well as auditors need time to digest the contents of it, technical part of it. And finally, 21-22 financial year, it has been made applicable. The overview of the order is to understand that there are 7 new clauses. 7 new clauses, including 2 that has been introduced on cash losses and internal audit. Modified clauses, 7. Retained clauses, 7. So 21 is a total number. So when you issue the final report, after generating the UDIN, etc., if I issue the final report, if clauses are not applicable, then with that, you put clause 5, 12 and 18 are not applicable. So then it will be 3 clauses. So other than that, you should have 18 clauses. That counter check you should do. And there are 47 subclauses. Or almost under every clause there are subclauses. This is a summary of changes. We'll first or rather highlight in this time the new clauses, 7 new clauses on the left-hand side. Transactions not recorded in the books of accounts. We did see that in Schedule 3 also there was a requirement to give details of transactions not recorded in the books. Here it's slightly different, the reporting requirement. The second one is ability of the company to meet its liabilities. We will see as we go by. The auditors now required to have a little bit of foresight, whether the company will be able to meet its liabilities, but only for 1 year. Somebody in lighter vein, somebody was saying, Jomon, anyway, the institute is changing the syllabus to align with international practices or a challenge from Indian Institute of Accountants, etc. Why don't you ask them to put a 20 marks paper, see a final on astrology also, astrology, because auditor has to know the Jyotisham to predict the future of the company. He said it's not that demanding. Based on the financial figures, etc., documented properly, you are asked to report whether the company would be able to meet its liabilities as and when they fall due within 12 months from the date of the balance sheet, not into an indefinite future. No, it is not that. Okay. CSR, a transfer of unspent amount to the various funds. 2 types. We will discuss that. Statutory audit resignation, which has been happening across 2 years back, but still there are audit resignations. If we are the incoming auditor, we have to get all the details, explanations from the outgoing auditor, requesting him what are the circumstances under which he had to resign and all the communication that the management had. CFS reference to negative remarks in subsidiary CARO. See, the holding company, the consolidated financial statements, CARO is not applicable. But if in any of the competent auditors reports, if there are negative remarks, then that has to be highlighted by the holding company CFS auditor in the auditor's report as a separate item. Per se, the whole CARO is not applicable for CFS, consolidated financial statements. Internal audit system, that which has been reintroduced. There's a new catch also, very interesting catch, and cash loss. That is there. We will touch upon this, and based on that, we'll move forward. Applicability from accounting periods commencing on after 1st April 2021. Every company, including a foreign company, government company, branches, if it is applicable, there's a company sitting in Chennai, CARO is applicable. It has got a branch in, let's say, Tirunelveli. That branch also will be covered. If it's audited by the statutory, another auditor, the statutory auditor, it will apply. Not applicable to banking company, insurance company, Section 8 company, one-person company, and small company. I think Palnisa's point is answered in the last bullet point. Small company under the Act shall be exempt even if it falls under any other eligible category. So that's where I have removed that particular, that is redundant. Private limited company with that borrowing clause will become redundant. If you're a small company, you are exempted. And be very clear, small company definition has undergone a change very recently. In September 2022, small company limits have been raised to 4 crores and 40 crores from 2 crores and 20 crores. So for the financial year 21-22, which we are discussing now, a small company means a private company, private limited company, whose paid up capital does not exceed 2 crores and turnover as per the latest audit accounts does not exceed 20 crores. That's the definition. The new definition which has come now is applicable only from 22-23. For our reporting, which we are discussing now, 21-22 financial, it is 2 crores and 20 crores. And the joinder is and. The original definition under 285 was or. And would imply that both the conditions have to be cumulatively satisfied to be a private, to be a small company. If the small company is a holding company of a foreign company, is CARO applicable? Yeah, if the small company is holding company, no, even then it will not be applicable. It will have only applicability only for the holding company. Foreign company, I presume that the holding company to CARO is applicable, but small company is a subsidiary of that. No, for the small company, no. For the subsidiary, it will not be. If you are a small company, the chain of holding subsidiary is not mentioned here. That is there for the applicability of accounting standards, small and medium company, etc. CFS have highlighted. So small company definition, please keep in mind. Neither should its paid up capital exceed 2 crores, nor the turnover 20 crores. 2 subsection 85 is the definition. Now we'll see the 7 clauses first. New clause, internal audit system. They have reintroduced from the earlier period, 2003 order. Whether the company has internal audit system comes right with the size of the company and the nature of its business. Look at the second bullet point. Whether the reports of internal auditors for the period under audit were considered by the statutory auditor. Now, as statutory auditors, we always ask this question: do you have an internal audit? The management says, yes, sir. We have internal audit. External or no, internal? These people only do the internal audit. Which of these? No, all of them do internal audit. The accounts department, he will point his head or finger to that department. Say that, sir, is there a report? No report, no report. We discuss every day. All the points we discuss every day. That is internal audit. That will not sell anymore. Whether it's an internal auditor or external by a chartered account firm, outside firm, there has to be a report, and the auditor, statutory auditor, has to report whether the reports of the internal audit for the period under audit were considered by statutory auditor. If you have to consider it, it should be there in the first place. You should see that. And ideally, this clause should have been there only for companies for which internal audit is mandatory under 138. There are thresholds mentioned. Why should this point become very relevant for a company which is not a small company section, even a small medium-sized company? But this is applicable irrespective of whether internal audit clause 138 is applicable or not. Chat box. Yes, my question is the same. Caro applicable, holding company, Caro applicable. Yeah, sir, please clarify. Holding, I did mention Mr. Alpasha, Mr. or Miss. Yeah, it is not applicable. Your holding company is a foreign company and your client is a subsidiary, which is a small company here. No, holding company, let me see. Holding company is a small company and subsidiary foreign company, whether Caro is applicable. Okay, see, small company limits have to be applied for both, no? For holding company as well as subsidiary company. So either the holding company or subsidiary company is not a small company. Apply the test of small company for both independently, and if to both they are both the small companies, for both the Caro will apply. If one is not a small company, then to that company it will apply. I hope I made the point clear. Yeah, Jayan Dashishal support. I hope I'm clear. You can type in there. If I'm not clear, I'll further explain. The point here is there's a holding company and a subsidiary company. One is foreign, one is Indian. Put the test of small company to both these companies independently. Forget that they are holding and subsidiary, A company and B company. If both are small companies, Caro is not applicable. Caro 2020 is not applicable for both. If either of them is not a small company, let's say turnover of 30 crores or capital of 3 crores, then it will apply to that company. The other company holding and subsidiary, that relation you don't have to see. Thank you. Both are small companies. Sorry, so you are relieved. Good. So internal auditors reports have to be there, and thus let us also do the documentation. Internal audit report if it is there, and in one case where it's again a C&AG audit where the internal auditors had not issued. We finalized at the end of April, and internal auditors had not issued the report for the Q4. So we got all the first, second, and third quarter reports, soft copies. It is scrutiny, and then it is in soft copy only. Gone are the days where we have thick box files as working notes. Where I think a lot of documentation has to be digitized. And so that has to happen. And the fourth quarter, internal auditors were also, while we were finalizing the statutory audit. So we said, in any case, internal audit has to be completed before we round up. And they gave us a draft report, and based on that, we said that, okay, they had been considered. There were no major adverse findings. Based on that, we reported under this particular clause. Whether the company has incurred cash losses in the financial year or in the immediately preceding financial year, if so, the amount has to be given. Nothing has to be explained here. Unrecorded income. See, Schedule 3, there was a requirement. And now we are in Caro. Whether transactions not recorded in the books of accounts that have been surrendered or disclosed income during the year in the assessment of income tax, whether previously unrecorded income has been recorded in the books of accounts during the year, properly recorded in the books of accounts during the year. Here it is about whether they have been accounted for in the books of accounts. Ideally, it should be accounted. The auditor should see it. True and fair would require that in the example that I gave of an immobile property worth 2 crores not being accounted, there in Schedule 3, it was only sufficient to give the details. But when Caro mandates that whether it has been reported, whether it has been recorded, to avoid a negative mark, the company will have to essentially account for it. Otherwise, true and fair also will be at stake. So what is the entry for this 2 crores? Ideally, in all the forums that I've discussed, my point is that land debtor 2 crores, with the tax at 60%, hypothetically, tax demand of 1.2 crores, to provision for taxation, if tax is already paid, fine, to bank, whatever, and then to revenue, 80 lakhs. You'll credit it to P&L account, 80 lakhs. That is the entry which we have to pass. So the auditor here under this clause has to say whether unrecorded transactions earlier, unearthed, disclosed, or surrendered in a tax assessment has been properly recorded in the books of accounts. This is my example, open for a debate, but somebody suggested that 80 lakhs should go to capital reserve. I say it cannot become capital reserve. It is out of, it could be out of, borrowings, but the basic inference is that it is out of concealed income, which has been accumulated over a period of time, and therefore it should go to the P&L account. Or revenue, it should be credited to revenue. Cash flows during the year or cash flows during the year are only as on date of balance sheet. No, cash flows, we don't call it as on the date of the balance sheet, sir. Cash flows during the year and the previous year. 21-22, whether you have a cash loss or not. 20-21, whether you have cash loss or not. Not on the date of the balance. That will be accumulated loss. What if the undisclosed income is subject to matter of appeal? Yeah, appeal, in which case the details of transactions undisclosed. It will have to be shown in Schedule 3. But here the auditor will have to say that, give the details and saying that the undisclosed income is pending before, whether it is a CH appeals or IT, wherever. And hence, because that will come as a contingent liability. That will come as a contingent liability. You can refer to that. That should be mentioned in the auditor's report. Please shoot questions. I'm okay. If I'm going fast on the answers, you can slow me down. You can type that also in the chat box. Interactive learning is very, very important. Otherwise, it becomes a long monologue. And also gives a feeling to the speaker that members are actually there. And this we did discuss, whether there has been any resignation of the statutory auditors during the year. If so, whether the auditor has taken into consideration the issues, objections, or concerns raised by the outgoing auditors. Now, 2 years back, if you see, there are a lot of resignations in the larger corporate sphere of our country. I think one of the Anil Ambani group companies, PwC, resigned. And the reason was cited that we are not able to obtain sufficient appropriate evidence to form an opinion on the financial information. I was introduced as a teacher. I always say I'm a CA by profession, but teacher by passion. Been teaching 20 long years. And in that, the first class on auditing, when you talk about evidence and SA 200, the takeoff standard, we say that the auditor should obtain sufficient appropriate, and they don't say sufficient appropriate audit evidence to base his assertions on forming an opinion on the financial information. Sufficient would mean quantity. Appropriate would mean relevance, quality of the evidence. Both are very, very important. That is where I did a recap, without probably giving regard to the seniority of some of the members who are online with us on some of the basic audit exercises which are not actually being done now. And today, we always say that, auditor is only a watchdog, not a bloodhound. This is not a shelter anymore. It's not a safe insurance policy for the profession. We are under the lens than ever before. NAFRA is flexing its muscles. You are getting reports on WhatsApp. NAFRA had taken very strong action against a multinational firm in IL and FS. 92,000 crores of irregularities and the 305-page report which NAFRA had issued. The crux of that is the same thing which happened in the company which I mentioned earlier. The auditors failed to obtain sufficient appropriate evidence in many of the relevant aspects, even confirmations. So we take for granted that whatever is there in the balance sheet is okay. Balance the year and balance confirmations, documents of title, verifying them, inventory verification, physical existence of that. I'll share with you one of the firms, again, a multinational firm. They sit in Pune, and the Indigo Paints, which is a listed company, so I can mention, which is the Dhoni and Zebra company. Everyone knows Indigo Paints. They had taken over a unit here in Cochin, and which was a standalone company. Now that is part of the Kalamassery unit. The company has been merged into this pre-IPO, and I think Indigo Paints share is doing very well. They're very aggressive on acquisitions and making it a pan-India brand. Competing with Asian Paints, but all of them. So this company is, because during COVID time, they could not visit Cochin. And they asked the promoter, the promoter of this company is still retained as a CEO and is still stake in the company. And he was asked to identify a firm to do a physical verification on behalf of this particular firm sitting in Pune. And we were asked to do this. The promoter is an ICAI, a very senior person. I can call him a friend. We are in the same Rotary Club. So he asked whether we can do it. And we finally said, we said the fees will be so much and there's no credit. Very important. Please not. We give undue credit to our client. He's a very senior person, but if I'm doing work which requires quick results, reporting formats heavy, we looked at all that and we quoted a certain fee, which he said is very high. I said, we cannot do that because you do not know the volume of work. The other day we gave an opinion and the client was referred to by a doctor. And the doctor said, since it is an opinion, with a short discussion, we did not fix the fees in advance. That's a mistake. This is only case probably I can remember where the fees was not discussed in advance. And the doctor, the neuro specialist is saying that your bill is very heavy. How can he say that? How can he judge that the bill is heavy or not? It's an opinion. Embedded the value of the opinion is so high that we thought it. I said no way, absolutely no, doctor. It is a discounted bill because it has been referred to by again another doctor who is very closely known to us. So fix the fees, collect in advance. In a recent 197 case, it had to be done, and we charged. I'm not sharing this figure. 2% of the TDS saving. So foreign company, for NRI, 23.92%. That is 20% plus 15% plus 4% surcharge. 23.92, and we got it 5 plus this, so 5.98. On the differential, which came to a few crores, we charge 2%, which is discussed in advance, and we got it done. And there also no credit. This is workable. It is not that we yield to the clients. And maybe in many of the firms may be charging 10,000 rupees. The time involved is not very huge. Getting information, compiling it, and my partner in charge. I don't practice tax anymore. I left income tax practice more than 10 years back for the sake of specialization. And in a multi-partner firm, we are 8 partners. What is the whole point in everyone doing everything? So today we have a tax partner, audit partner, compliance partner, internal audit and technology partner, and one is purely for GST. This is not wasting time. These are things which we should experiment. And this has been we have been fairly successful in doing this. So spare time. See, when I was chairman of the region, I was traveling across. I said I cannot commit any time to the firm during 1920. And we took a junior partner and we managed. So these are things which that is incidental to say that this firm, again, coming back to this multinational firm, after engaging us, is all signed up and we went there. The first thing we were asked to do was to take a group fee in front of the factory, my partner and 3 of our assistants. Group fee in front of that and WhatsApp to them. That becomes audit documents. And the whole process that we did, the physical verification, was live video streamed. And there was a audit manager and one partner also came in between watching this real time sitting in Pune. So to that is SF501. Additional special considerations for selected items. Request the auditor's presence or at least virtual presence. The same thing I'm doing now. A client of ours is in operation in Kolkata. My son is studying there. So I've asked him to go talk to the client. He will go there, take photographs. We'll have a live session like this. We cannot do it in March. So we'll relate. The stock register will relate back. At least ensure that the company is there, factory is there, inventory is there, people are there, at least to that extent. And then that probably all come as a WhatsApp or whatever messages, convert that into emails and store it in the client folder. So that is about being the sufficient appropriate evidence. So here this point is there. It's my version. Concerns raised by the outgoing audit in the auditor's report, communication with the management, etc. Discuss threadbare and include that in the LOR, management representation letter also. You can ask the management to, whatever the auditor says, that's only one side of the story. Relate this, collate this, and what we call it is the evidence has to be related and correlated and ensure that all these things are considered by the auditor and reported. Now, this is the astrology point which we are referring to. On the basis of financial ratios, aging and expected dates of realization of financial assets and payment of financial liabilities, other information accompanying financial statements, auditor's knowledge of the board of directors and management plans, etc., whether the auditor is of the opinion that no material certainty exists as on the date of the auditor's report, that the company is capable of meeting its liabilities existing on the balance sheet date, 31/3/2022, as and when the fall due within a period of 12 months from the end of the balance sheet date. So a little bit of foresight. And we have been asked specifically to which are the hitting points of reference points on the basis of financial ratios. We have it handy there. The new format of Schedule 3 gives us a list of the ratios. So if it is prepared by the management, get it checked. If it's prepared by our own team, which is not official, off the record, if prepared by our own team, you have it in your system. And based on that, you check, all those ratios are healthy, going is good. So there are no worries. The auditor can. Even with that, it can go wrong. A major event that happens now in September or October can have a telling effect on the capability of meeting its liabilities. They may go default in a short span of time. But given the situations which existed, properly documented, the auditor has to see whether report this very clearly. Get written representation on the realizability of receivables and other financial assets. Board's documentation, board minutes, if you scrutinize, include specifically all the material events, etc., in the management representation letter on paying capacity. If there is anything which impairs the paying capacity, etc., then the audit has to be extremely careful. New clause 6 is CSR. CSR now, it needs 2 minutes of explanation. I gave you the backdrop of CSR and said that it's not a very friendly section now. 135 is always read with Schedule 7 to the Companies Act, which gives a list of eligible CSR activities. I worked with a few NGOs and we got it registered with the MCA. All these NGOs for a kind of information, because today there's a challenge. There are companies who are finding it difficult to validate the NGOs. So I was part of a management association where we did a CSR conclave, bringing together the corporates who have the obligations under CSR, under Companies Act, the 2% based on turnover, net worth, etc., profit, etc., and good the NGOs for delivering value of good transparent systems, and we got many of them married, and that relationship continues. So as a part of the Kerala Management Association, it's under IMA. Some of you may be members of local management associations, MMA and all that. And I was secretary last year, 2 years. Both the years we got the best LMI award in our category, and our team received the award, I think, yesterday. I could not go to Delhi, day before yesterday, from Amitabh Kant, chairman of the Planning Commission. Now I think he's Sherpa to PM Sherpa to G7 and G20. I'm sorry, G20, and a team received this award. That is incidental. So here, if CSR is applicable, you have to categorize projects between ongoing projects and other than ongoing projects. It can happen that you take up a project, for example, in a remote tribal village. We have Attapadi in Kerala, for example. We're saying that we're going to do some housing projects, some sanitation, setting up a Anganwadi, food center, vocational training center. This is going to take about 2.5 years, so 2 years. So ongoing projects are multi-year projects, but cannot exceed more than 3 years. And you're saying that this year, my CSR obligation is 5 crores. I am splitting that, saying that 3 crores for this particular project, which is an ongoing project, 2 crores for other than ongoing projects. Other than ongoing projects would mean that this 2 crores have to be spent within 21-22 itself. 21-22 itself. So look at this now. I have given the background. 5 crores is the total obligation. 3 crores for ongoing projects. That is the Attapadi project, multi, sanitation, housing, education, school, Anganwadi, primary health center, all those things put together. We're doing this. Okay. 3 crores for that. Let's look at paragraph 2, which is 135.5. Any amount remaining unspent under 135.5 on any ongoing project should be transferred to special account within compliance of subsection 6 of the Companies Act, 135 of the Companies Act. Ongoing project means this is what you have to do, cannot complete in within a year. 3 crores you can do, we have time for this year, next year, and part of the 22, 23, 23, 24 also. So here the requirement 135.6 is that such amount unspent should be transferred within 30 days from the close of the year. That's the requirement. In where like a capital gains account to a designated bank account, which can then be spent in the next 1.5 years only for this particular project. Maybe CA validation is also included. I've not gone to that extent. MCA would probably insist on that. Opportunity for us. CSR consulting is also an opportunity for us. We have been asked to do a CSR policy for a bank in Kerala. I was surprised that now a full-fledged policy, a bank in Kerala. And since being a bank, a listed company making huge profits, the responsibility was huge. We quoted a fees and they said for that fees, no, I don't think they've done it yet. Very, very unfortunate to say that. So penny wise, pound foolish, as I say. And so here, the point is, it's an ongoing project. 31st March 2022, whatever is not spent should be transferred to a designated account within 1 month, 30 days from the end of the financial year. If it is not done, the auditor has to report. Now we go back to paragraph 1. Other than ongoing projects, which should have been spent by 31st March 2022. That is the 2 crores. Total is 5 crores. 3 crores is on bullet number 2, paragraph ongoing project. Yes. Out of that, we have spent only, let's say, 2 crores. So balance 1 crore within 1 month has to be spent, put in the bank account. In the case of other than ongoing projects, this 2 crores, 5 minus 3, 2 crores, if it's not spent, it has to be transferred to any of the funds mentioned, the PM Relief Fund or the CM's Flood Relief Fund, Disaster Relief Fund, within 6 months. It's gone. It's gone from you. You said that, okay, I'll spend 2 crores on other than ongoing projects, current year, in the current year. Meaning other than ongoing projects means in the current year on certain projects. You failed to do that. Of the 2 crores, you could spend only 50 lakhs. Balance 1.5 lakhs, 1.5 crores. 50 lakhs only you spend. Balance 1.5 crores will be transferred to PM's Relief Fund, any of the funds mentioned in Schedule 7 with a period of 6 months. This is the provision of law, and the auditor has to check whether this has actually been done. Caro remarks of other auditors, yes. I did mention the background. CFS is not applicable, but any of the competent auditors have qualifications. The statutory auditor of the holding company who signed the consolidated financial statement should highlight that in this report. This brings us to the end of Caro, the new clauses. Other than the modified clauses, which I think there's some familiarity, and the retained clauses, there are certain things, because it's not just Schedule 3 and Caro. We gave that intro, and then it's all you need to know. There are certain things which are important. We'll complete that. It's almost 7 o'clock. We will run through that quickly run through that in the next 5 minutes or so, and 5 to 7 minutes and round up. Cash flow statements. Now, it is not governed by accounting standards. Section 2, subsection 40 of the Act says that all companies, because the definition of financial statements will include balance sheet, P&L, cash flow, and SOSE. SOSE statement of changes in equity is applicable only for Ind AS companies as of now. So, meaning all companies except small, dormant, and OPCs must prepare cash flow statements as part of their financial statements. Cash flow is mandatory that way. Small companies exempted, dormant, and OPCs. All other companies' cash flows. Many of the companies do not know. Many of the auditors, our friends, colleagues in the profession, are not aware of this. And if that is there, auditor's report should also be customized. So I did not mention, because of Schedule 3 amendments and Caro 2020, one thing which I've told the students here and the partners here is that, hey, look here, 21-22 cannot be a copy-paste year. You're not just changing the year, it's not huge changes. So in the client folder, the first thing I instructed was, when you open a client folder for 21-22, if you're copying something from 2021, delete the auditor's report. It's a completely new format. And we have another repository called the ShareBin, where we say that this has to be auditors, draft of the auditor's report has to be drawn from there and then customized client. Anyway, we'll see that later. So cash flow is mandatory. Depreciation, I think we'll skip Schedule 2, useful lives based on that, not rate based today. And for intangible assets, AS 26 will continue to apply. The cardinal principle is that the useful asset of life of an intangible will not exceed 10 years. If it's computer software, web design costs, etc., it's only 5 years. They have to be amortized over a period of 10 years or 5 years, as the case may be. Accounting standards. Sundaran sir did mention about having an accounting standard, a full-fledged standard in agriculture. I'm excited to work on that. All accounting standards will apply. How many accounting standards are there? We are leaving not Ind AS. Ind AS is for the time being not part of the discussion. Listed companies, small and big, and other unlisted companies, including NBFCs, having net worth of more than 250 crores only Ind AS is happening. But accounting standards, which we all studied in our CA Inter final, all those things. Now, I did my article from 88 to 91. So we are all fortunate, only very few standards are there. Now, we're advising the students to pass out fast, failing which will have more standards to study and apply. So 29 minus 2 standards are there. Somebody did mention a reference to AS 16, encouraging borrowing costs. So these accounting standards will apply. That's the chat. Sir, 30-30, I agree. 30-32, 30-32. In that 30-31, 32 financial instruments were never notified. So we stopped at 29. And minus 2, I am saying this. Yeah, AS10, we'll discuss that separately, sir. I think we have plenty of time now. Let me rush through. Probably one-to-one we can discuss. AS10 does make, but that's not fully on agriculture. That's only on, as you said, the plants and all those things, biological assets, as I say. 29 minus 2, because AS6 depreciation is fully withdrawn. Depreciation is now found in paragraph 40 to 60 of AS10, property, plant and equipment. AS8 was withdrawn long back, that is on research and development. Treatment of R&D expenditure is again dealt with in accounting standard 26 on intangible assets. So 29 minus 2 standards, a lot of amendments, and there have been amendments. I mean, 2006 the rules rolled out. 16 is amendment. 21 also there is an amendment. The definition of a small and medium company that so certain standards which are very important. Accounting standard 15, employee benefits. People, members are taking it very casually. For every company, small and big, actuarial valuation is not mandatory. If it's not done, company's own computation is done, it should be qualified in the auditor's report. 16, borrowing costs. Borrowing costs, if you are a trader just buying and selling onions and potatoes, working capital facility, entire thing has to be expensed. But if you're borrowing on a qualifying asset, borrowing to have an outlay on a qualifying asset, an asset which would take more than 12 months for its intended use or sale, then that portion of the apportionable portion of borrowing cost should be added to the cost of the asset. That is the underlying principle. AS 18, related party disclosures, many of them we are not showing because the mandatory requirement. And one more danger that we do is we don't show this here and we show it under 48(2)(b), 3CD. Or we show it here and then forget to show it under 48(2)(b). That's dangerous. The taxman is cross-checking now. And today, or a period of time, the system will have all these interfaces. Mismatches would be coming up as exception reports. And the auditor can be taken to task for signing it, saying that all the disclosures have been made. 22, taxes on income. Deferred tax, one has to be extremely clear. 26, intangible assets. So then, sir, I'll conclude in 5 minutes. Konja or shoot touch. Right. Okay. 26 is intangible assets. I did mention. There's nothing called deferred revenue expenditure. Preliminary expenses have to be expensed in the year in which they are incurred. Yeah, we will round up now. Standards on auditing, I did mention. This is people are giving scant regard to standards on auditing, mandatory under 143(9). It's not only the institute disciplinary committee. It is a NFRA, the MCA can come down on you, or we can be, not you, you and me, can take us to task, and therefore one has to be clear. 210, getting letter of engagement. 220, quality control. 230, documentation. 300, planning. 315, understanding an entity and risk assessment. 500, evidence. 501, I did mention, inventory, litigation, and segment reporting. 505, external confirmations. 510, initial engagements, opening balances. 570 was a standard which was quite in discussion in the last 2 years. It's about going concern. So the COVID uncertainties, going concern was a big question for many entities. That was extensively applied, referred and applied during the last 2 years. Those who could survive and move on, like tourism companies, resorts and all that, who could survive, they are getting good bookings now. There's something called the revenge spending, revenge tourism, revenge economy. People who have not been able to travel would bounce back and travel. And people who have not been able to spend the way they were spending, they would spend more. So they are coming back. So that's not a major concern. But even in cases where going concern is at stake, 570 is a very important standard. 580 is written representations, management representation letter. Reporting, these are the three standards, very important. The other reporting points, I think we can only run through. IFC reporting, internal financial control reporting, which the institute said it is ICOFA, internal controls over financial reporting. It is relaxed. Small companies are exempt. Companies with turnover of less than 50 crores and borrowing less than 25 crores are exempted. Provided they have filed AOC for the no pending AOC 4 and MGT7. Audited accounts and annual return has been filed. Even though the delay is okay, but as at the time when you apply, whether ICOFA is applicable, IFC reporting is applicable, there should not be any pending filing of annual return under Section 1, Section 92, and the accounts under 137. So we had to rush through towards the end because some of the points required threadbare discussion, and I think I would have spent 5 to 7 minutes on off-topic discussions, which were equally relevant for practicing chartered accountants. So with that, let me conclude with a big thank you to Sundarajan sir for being there throughout, and to the chairman, secretary, most importantly to the 115 of the members who are still with us. And so thank you very much. I have 2 more questions. Let me, NGO borrowings more than 25 crores if it's applicable. NGO borrowings from NGOs. Oh, thank you, Bala sir. Thank you. And Jerome sir also said thank you. So
yes, sir.
Yeah,
Sir,
so,
thank you, sir. Thank you so much for your beautiful presentation. I was under the impression that I'm sitting in a class. You've been a good teacher. I really felt that today. I'm very happy about it. And I have a small case, which I also wanted to put it as a question.
Yeah.
Because one of the chartered accountant has applied for no objection certificate from me for taking over his private limited company. He wants to take over, but the company has not approached me.
then he is grossly at fault and risk.
Now, I told the chartered accountant, because being young, I told her that you can take over, man, no problem. I'll give you no objection later.
No. You should not agree to that. Maybe you're too friendly. You are too lenient.
Sir,
the company should approach. And again, this point, because since we are members still on board with this 100 of them. See, auditor cannot be removed. Under the Companies Act 2013 regime, we have been appointed for a period of 5 years. Now, the second appointment came in 2019. So that will go on till 2024. In that period, resign. You cannot be removed. You can be removed only with the permission of the central government. MCA.
That process they have not done.
They have done. Resign. If you resign, first thing is the management will probably approach you. Sir, somebody we have to support. Maybe some person, some favor or some pressure is there. Or you are too busy.
That's what my partner is telling me. Sir,
the company should tell you. Company should tell you. And if you do not resign, they have no option to appoint anybody else. But today, young members, please not. Younger members, I'm sitting as chairman of the southern region at SIRC office. Most of the disciplinary cases which are coming up there are for taking up audits in a hurry. So audit resignation, if it is there, that cannot be filled by the board. Casual vacancy caused by resignation can be filled by the company in general meeting only. Insist on a properly convened board meeting, a general meeting, the minutes, the resolution, and of course, communicate with the previous auditor. Don't take up audits in a hurry. Very, very dangerous.
Yes.
So, my answer to your question is, you should not respond to a chartered accountant, fellow practicing chartered accountant, with due respect to my brethren, who has directly communicated to you without reports to the company. And company has not asked you anything. If I were in your place, I would have put it like this in the dustbin.
But being young,
that kind of high-handedness we should not accommodate. That high-handedness we should not accommodate. Who is
I'll ask a client also to send me a letter and confirm it.
You should do.
Procedures. But anyway, but this is what is happening. That's what I wanted to highlight here. Because the chartered accountants being young, they wanted to they wanted to take over the company.
Yeah, sir, chat box live session. Hats off to your speaking Tamil. I was speaking good Tamil because I did my articles in Chennai.
Yes, sir.
And we were staying in an apartment, so we are doing cooking also. So
Yes, sir. Yes, sir.
when I was in SIRC, Selva would tell you that with the staff I was mostly communicating in Tamil.
Yes, sir. Yes, sir. Yes, sir.
Yes, sir.
Yes. And another point, what you said is I totally agree, because when we did our education, like when we completed our course, there was no accounting standard.
We are lucky.
We should be happy for that. But anyway,
sir, please ask one more question. Can I ask? Until Sundarajan sir is the captain, he is in command. So I'll try to answer. Can I ask one more question?
Yes, sir. Yes, sir. We can answer.
Chokra, sir. Yeah. ESI, PF, GST paid regularly. We have a reporting requirement. And the clause, sir, those are the retained clauses. Because of this time, because we could not fully focus on CARO 2020, I have covered only the new clauses. I gave that amended clauses, retained clauses, and first 7 new clauses only we have discussed in CARO. So ESI, PF, GST and the clauses.
Sir, that's new clause, sir.
That only we discussed now. Only that we discuss now. Other points, all of them are still intact and relevant. What is IFC report? IFC refers to internal financial controls that came in a few years back, and it is in addition to the CARO report. And the IFC report, there's a separate guidance note of the institute. So when they said the chartered account should refer under 143, I'm not able to recall the subsection. 143, if you see, there is a reporting requirement on internal financial controls. So the institute said the auditor cannot be asked to report on the whole government of internal financial controls. Other than that, there could be operational controls. You know, if you are an engineering company, a lot of operational controls. It is not the auditor's domain. He doesn't have the expertise. So the institute finally came out and got this clarification saying that the chartered account should report on internal controls over financial reporting, financial aspects. That is IFC report. It's a mandatory requirement. And what we have discussed now, small companies are exempt, and those companies, I think borrowings of 50 crores of capital, I'll just go back to that slide to make it clear.
So the latest amendment is applicable, sir. Small company?
Small company 22-23 in the 21-22 all definition. I did mention. Company with turnover of less than 50 crores and borrowing less than 25 crores, this IFC reporting is not applicable, provided they are compliant with 192 and 137. IFC report has a few more questions. Do we need to upload independent auditor CARO while uploading tax audit report? My God, I'm not too sure. I'll just check.
They both are different.
You know, auditors, a company audit, statutory audit report.
They both are uploaded in a different site, sir.
Yes, sir, it's required because we are in 3CA, we are referring to that. The statutory audit of the tax audit of a company, we are issuing 3CA, right? There's no expression of opinion. In 3CA, we are making a reference to the audit done under the Companies Act and the financial statements, and then we are referring to that. So it has to be done. Tax experts can add on. I may be proven wrong.
Yes, sir. Thank you, sir. Thank you so much, and thank you to the
memento. Memento.
Yes, sir.
Memento is in Orco, yes, sir.
Memento will come back.
No, don't send any memento. Memento, there's no space for keeping mementos.
No, sir. I know. We know, sir.
Thank you so much, sir.
Thank you so much. Thank you, participants, for the very, very interactive session that kept me going. And normally, after 2-hour session, you feel tired. I feel like I can go for
normally we take the questionnaire section last, but it has been on live.
The concurrent only when it goes concurrent, it does that because the questions also will become stale after some time. And for the speaker, when you are at a particular topic or clause, it is easier to answer, and otherwise recalling all this will be difficult. So wonderful time at SIRC, recalling our good days together. We'll come down to Chennai, sir, to enjoy hospitality and also to
Please come, sir. When you are coming, just give a ping, sir. I'll meet you. Thank you, sir.
My pleasure. Thank you.
Thank
all.
you so much. Sir.
Thank
Thank you, sir.
Thank you.
Thank you.